Getting rich from property isn't for everyone, or is it? Tonight, we have a cracking session where we have over 4 decades and well over 10,000 property portfolios helped out and created by the two guests we have, Jordan Jong and Scotty Aggett. They unpack the secrets and the truth from getting rich through property, the ins and outs. Should you be chasing the next hotspot, or should you be sticking to the fundamentals and what has worked time and time again? These are the kind of key insights that you need to be considering if you're going to be buying and expanding that property portfolio in 2025 and beyond. Hey everybody, I'm Jeff Miles, and together with Joe Tucker, we've created Australia's largest property Facebook community with over 78,000 property investors. Each week, we interview top property experts, and you get to sit along and be part of that. Buckle up, this is a session you won't want to miss if you want to understand the truth about getting rich through property. With Jordan Jong, Game Plans, and expert property negotiator, Scott Aggett. Let's jump in. What are the things you're seeing, Scott, that investors face and their challenges along the way in your 3 decades of experience?
Poorly thought through foundation properties, I think, is one of the key things that comes up for me a huge amount when we talk to investors that are trying to build a portfolio on top of an existing start. And they've bought properties that they could have just set themselves up for, to fast track their future, like that one that Jordan's just explained. That's a big problem for us. Like, we would look at it and we'd say, okay, we're second man in. They've already used someone else on that first property, and now that's a bit of a noose around their neck. Maybe not quite the version of it's a dud asset and they need to kill it off and take that loss, but it's also not the optimal property to build from. So that's one of the things that I see consistently come up as well. I don't know if, Geordie, that's something that you've noticed a lot when you're talking to new investors. And I think all of these things, I should premise this with, a lot of this was done by, in years gone by, I think there's a lot of bad financial advisors, a lot of property spruikers. There wasn't the same level of access to data. There wasn't the same professionalism in the industry and the growing, professional services around buyers agents. So I think a lot of this is going to go away. We're going to see less of this going forward. But it is an interesting trend for me still that people are looking to buy that first property or have bought that first property, and it's a terrible foundation to build from.
Yeah, 100%. It's a big thing that we see, and I'll probably bring this up a few times today. But everyone's kind of capped at their borrowing capacity limit, and if you don't utilize your borrowing capacity to the best of its ability and get into some of those foundational, fundamental properties to begin with, then we commonly say that it's harder to save at the rate that property grows, and so getting into your first property generally takes the longest. Most people are saving for 6 months, a year, 2 years, 3 years to get into their first property. And then the idea behind building out a portfolio is once you're in that first one, you leverage off the equity, take out the borrowable equity, and that helps you get into property number 2 and 3. Because if you're spending another year, 2 years, 3 years saving for a deposit for those purchases, it's going to take 20 years to build out a decent portfolio. So if you get that first one wrong, 100%. You're starting on the back foot.
Yeah, so that's one of the key things I see. And I think the other thing for me, Jeff, if you jump into my other point that I think was a key one again this year, is so many of the investors that we worked with got incredibly into the weeds about the numbers and the data. And it would almost be to their detriment in terms of they would overlook high quality assets in growth locations that meet their criteria because of very specific things, really narrow minded stuff. And it might be, I loosely say this to customers always, but the blue kitchen and the pink door or whatever is what they're looking for, but they can't find that. So they just won't make a decision. So they're either indecisive or they walk away from a fantastic opportunity. One of the key things for us as well, you might get really close on the numbers, but not close by $10 a week post-tax or whatever it might be, and people will walk away from it because of that, even though they're looking at a property that might be going up, as we just said, at 20, 30, 40% in the first year. So small decisions like that make a big decision, big outcome long term. So getting right into the weeds with some of these things can be a negative, I think, for some of the investors that we dealt with this year as well. And go back to the bit that you opened with, where you were talking about those property cycles, and we talked about off air. We've seen so much talk in the industry from buyers agents right across the country talking about Melbourne and being in that cycle now, and trying to get ahead of that in terms of being right at the start of that next growth cycle. How much do you think, when you're looking at all of the gossip, all of the talk online, all of the marketing, do you feel like it's just a swarm of bees that are following each other around Australia? Basically, everyone's got access to similar data. A lot of the buyers agents are using the same data. Do you think that's going to cause problems? Because this is an interesting trend that I think we're seeing more and more of now as more buyers agents enter the market. It's so hectic buying. If you go back to, late last year, Perth, the year before that, Adelaide, Townsville, all this year, Gladstone, those locations, just buying an investment property in those locations as a professional buyer has been really difficult. People are overpaying for these assets. What do you think the trend is going to be with that? Is there a way of getting ahead of the curve with that without taking risks? Is it going to be a case of having to come up with different strategies altogether as to where you buy to circumnavigate that? Is there a way around that, do you think?
Yeah, I think first and foremost, if you want to be a super active sort of investor, it's listening to all the podcasts, it's listening to what people say online. And like, I know a lot of the buyers agents personally, and I know a lot of them give away a lot of the gold up front. I know there's a few of them that were talking about Melbourne, even a year ago or 2 years ago. And if you were listening to their podcast and listening to all that sort of stuff, you kind of see some early signs, some green shoots of some positivity around those markets. But I think with anything, and this is one thing that I'm a big fan of, like I used to listen to everyone, and I'd be so conflicted in my own head around, well, this person's saying X, this person's saying Y, this other person's saying do none of that, go into crypto, this person's saying go and do everything else. I think there's so much information that's out there, and I think one thing that I wish I had knew a little bit earlier on is it's fine to listen to everyone, but I think eventually you just need to pick one or two people that you really resonate with in terms of a strategy. And if it is that active strategy of trying to get into these markets earlier, and trying to get in before these, as Scotty says, bees of people that are coming through and flowing through into those markets, then stick with those individuals and stick to listening to them and what you want to do. But if you're maybe a longer term planner and you kind of want to have that longer term big picture, and you're happy to have that like kind of sit and hold type of thing. For me, like looking at markets in terms of a span of 5 years doesn't really fuss me. Like I'm happy to sit in the market for that entire market cycle of 7 to 15 years or multiple decades of market cycles. And so fundamentals for me are really important in terms of like, I want to just make sure this is a fundamental asset that I can hold on to for 30 years, because regardless of what happens to the markets, I know we're going to end up in a good position later on. Where if you're maybe starting out building your portfolio and you want to get into those high growth areas first to kind of leverage into where you are, yes, it's a more riskier play because you're banking on this hypothetical of, well, this market is going to increase rapidly in the next little while and I can bank on that equity and then move into property number 2 or 3. It might have a massive payoff for you and work out really well in your favor, but it is more riskier if you're potentially getting into those markets who don't have stronger fundamentals long-term, big picture, and might have underperformed considering the rest of the markets all around the country. So I think, look at your approach, look at your mentors, look at who you're listening to and what actually you want to do out of your portfolio first. And then if you are looking at that active investing strategy and trying to get into these markets, I would just be very cautious of, you don't necessarily have to be first in. You can kind of go in with the early green shoots and early crowd that's going in. But if there's people that have been slamming those markets for the last 4 or 5 years, and there's been, for me, like if there's been more than 50% growth in 3 years, I'm kind of like, well, there's been a lot of growth here. Is it going to continue to grow at that rate? Or should I be a little bit more conservative and taking a conservative approach on it? So it is
so
more
is that
about
you out of Adelaide, Brisbane, Perth, Gladstone, Townsville,
100%.
Mackay, all these different locations? Is that a hard no for you in that regard?
I personally wouldn't be buying in them right now, just because, fundamentally long term, if you want to be in those areas, I think it's fine. But if you're looking for that short term growth, those types of markets that have increased at a ridiculous rate might go through a period now of stagnating. Could be completely wrong. I haven't assessed in all the markets in terms of research analytically, but markets do have their cycles. And so when you see lots of that growth, what's got to happen now is owner occupiers in those areas have actually got to catch up to the new prices that are in that area, and the economy's got to sort of level itself out in those areas. And so you could see periods of slowdown. But yeah, for me, I'd probably want to take that counter-cyclical play if I was looking to get that sort of short-term growth.
What are your thoughts seeing over 6,000 portfolios, Jordan? What do you kind of see the more successful? I think the answer is just to take it, sort of take a bit of the hype out of it, and just let time.
Yeah, I'll reinforce what Scotty said, but I'll just say it in a different way. Is just to avoid the shiny object syndrome. So I've seen so many portfolios where they're just absolutely butchered. They bought this first property because their uncle told them that it was a great investment. It's around the corner from them. Then they bought the second one, which was a house and land estate, because they got sold this really nice PDF document with some great marketing on it. And then, they bought this house that they were going to renovate and flip, but then they never renovated. And then they bought this other subdivision that they were going to subdivide and put two houses on that they never did. And there's just this amalgamation of shiny object syndrome of, and to be honest with you, it's exactly what Scott said before in terms of really good marketing and sales tactics from lots of people that are out there. But they kind of get sold this dream and all these different things, and there's no real clear pathway to what they want out of their portfolio. They've just seen people being successful in property, been led down a false pathway, and unfortunately bought the wrong thing, and it's really impacted their long-term plan or what they actually want out of their portfolio. It's just this amalgamation of that asset. So I would say, as Scotty said, pick some mentors, pick some people you really resonate with, have a plan and stick to your plan and try and avoid that shiny object syndrome. But to answer it really simply in terms of average household income, stock, you're building out a family portfolio together, nothing building out anything crazy. I'd say most people can achieve their goals within 3 to 5 properties. You're not required to have this 20 property portfolio. It's going to be this massive thing. And the way we generally see this unfold is we get into 1 to 3 residential assets, depending on how you best want to utilize your borrowing capacity and manage your cash flow. In terms of, if you go high growth, it's going to be lower cash flow. If you go more cash flow, then your cash flow position is going to be balanced. So 1 to 3 residential properties, we max out our borrowing capacity in the residential space, and then we buy 1 or 2 more commercial assets, utilizing things like lease stock loans, which allow us to keep doing borrowing outside of our personal names. So everyone's kind of capped at their borrowing capacity. So we leverage that up front, get into the best possible assets that we can in terms of the residential space. Then we move to commercial, and we can do that all within 3 to 5 properties. If you do that right, time it right, buy it in a nice acquisition window, you can generally look to build a passive income of anywhere between 100 to 200K over a 15 to 30-year time horizon. So from a really simple stock standard way of building out a portfolio, that's one way that we've seen a lot of people win in terms of long-term planning.
Jeez. Yeah, nice.
Do you see the pattern? I think that's changing for equity, release of equity to sale a property to reset and then buy another asset. You've seen the 6,000, Jordan. Are you seeing that come up more and more in 2023, 2024? What are you seeing with that?
Yeah, so in terms of the selling side of things, I think there's probably 2 cases where you do want to sell. Is number one, if you have a dud asset, like you want to get rid of that and cut your losses. Number 2 is if you are taking that active strategy of, looking to get into areas with high growth, get in and get out. You want to get out while there's still some active investors getting in there, because you don't want to be the last person out. If you're trying to sell when everyone else is trying to sell, then you're just competing with everyone else that's putting their property on the market, and not going to be ideal. The only thing that I would say about, pulling out equity and extracting equity, the good thing about it is if you extract equity, you don't trigger that CGT event. And for me, the transaction cost of property is so high as well. So it costs about 6% to get into a property with stamp duty, building repairs, conveyancing, all that sort of stuff, and about 3% to get out. So agent selling fees, all the other stuff, all the documentation, all that sort of stuff as well. So in order for you to get in and out of property, you need a minimum of a 10% growth rate. Now, yes, if you got in at 2019 and you've had that 50% or doubling of your property's value over that period of time, 10% is not too much to pay given the growth that you've had. If you've doubled from 500 to a million, let's say, for example, like it's not too bad to trade in and trade out, capture that growth, and then recycle that into another property. But if you
get it right, hey, like if you time it right, if you don't time it right and you give up on, as Jeff said, the last 20 or 30% in Perth and you sit in Melbourne for 3 years with nothing, then you've just wiped away all of that good plan.
100%. And as I said before, you are capped on all your borrowing capacity. So if you are absolutely maxed out and you are in that position where you want to go again, but you can't unless you sell, you know, if you can capitalize on that position, you pay your CGT and you know you're in still a really nice positive position, by all means, get out, get into another market and continue to grow it that way. It's just a more sort of riskier play because you need that 10% to get in and get out. Plus, you got to pay CGT. Then you got to try and get into another market that's going to have another growth spurt as well, which you're not guaranteed of. So, you know, I think now that we're seeing a lot more buyers agencies and investors coming into the market, as Scotty said, there is going to be a lot more of that secondary tier market of getting in and getting out.
I think the biggest thing for me that I'm wary of with social media is everyone's looking for a marketing edge and everyone is looking for the next best hotspot. And there's a lot of people that are very short term in their thinking in terms of making money off people for their own self-interest. So you've got to be very cautious of all this hotspot locations and the next best thing. And chasing that, we've spoken about, is that going to be a trend? I think it will be in terms of people turning and burning in locations when their growth cycle is up, but also getting into these other new cycles just because it's the new black. I'd also be incredibly cautious of it as well. In the reverse of that is I've had so many people in the last 12 months and probably the last 6 months, especially saying, apartments in Melbourne are going to come back. And I'm like, okay, why? Why is that? And it's almost like there's a mentality with some people like, well, it's been down so long, it's going to turn the corner and bounce back. I'm like, but that's just
too much supply.
That makes no, well, it makes no sense because all I have is clients all day that ring me that didn't buy through us years ago and are trying to use our agent selection service to offload dud properties that they can't sell. And, I've got one today, unfortunately. They've had 2 agents try to sell it and they were trying to sell it for the 3rd time in a year. They've spent about $15,000 in marketing, styling, having the property vacant, and they still can't sell it because there's just no demand for these things. So no matter how cheap these things are, no matter how long the cycle's been that they've been down, and no matter how good the yield is, I think you've got to be really cautious about certain types of assets as well.
2025, your top tip for somebody looking to sort of start or get a portfolio?
I mean, I'd say the best thing is number one, figure out what you actually want out of your portfolio. Do you want growth? Do you want cash flow? Do you want neutral? When do you want to retire? Really write down and see what your long-term goals and aspirations are. Once you've got a bit of a plan or a bit of an agenda in terms of what you want, work with an expert that you feel comfortable with, that you resonate with, that you match their strategy with, and build a team around you, mortgage broker, accountant, property buyer. Have a really good team around you to help understand and build out the portfolio for you, because I went at my own and got stuck at a certain level, and these guys are doing it day in and day out, and build portfolios. So go and work with someone who can help build it up for you from that side of things. If it is you want to get into a market that's going to grow, I would look at areas that haven't necessarily performed over the last little while. Maybe catch wind of some of these other areas that some experts are saying they're looking to buy into. For me, that would just be Melbourne, because I've heard a lot of on the ground people are talking about it, a lot of data and all that sort of stuff. Starting to see some green shoots. But yeah, I mean, I'm not on the ground doing the negotiation. I'm not in the data, looking at all the data and information. So work with a professional who is.
Nice.
That's another good face from Jeff there.
Yeah. And always the one for me is buy when the time suits you, when you can afford it, when you're comfortable in your decision making, and buy the right property that fits the criteria that you're comfortable with. Because I hear from so many investors about they're rushing because they've seen other people build a portfolio, or they're into a particular location because they've read something about it. I think step back from that, buy the right property that's right for you when the timing suits you to do it, and do that within your capacity so that you don't get forced into have to selling an asset later. When Geordie said earlier that you get stuck when rates go up, they might go up 2% and you can't afford to hold that property and the whole thing goes kaput. So yeah, it's about buying within your means. And that's one of the big things I've learned over the 30 years I've done this as well. I've seen lots of people buy lots of properties and then end up having to sell really good assets because they bought outside of their means.